Good morning, everyone. Today we will present a comparative financial analysis of three distinct companies: Starbucks from the consumer services sector, NOI from the high-growth electric vehicles industry, and Johnson & Johnson from the stable healthcare sector. Our analysis will cover liquidity, in efficiency, leverage, profitability, and returns. We begin with liquidity analysis, assessing the company's ability to meet short-term obligation. The term from 2023 to 2024 shows concerning signals. Starbucks shows its current retail decline from 0.78 to 0.75, consistently below the benchmark of. This shows weak short-term liquidity. However, strong and stable operating cash flow helps reduce the risk. The credit ratio also fell from 0.59 to 0.56, which means immediate liquidity is limited after removing inventory. NIO has a more serious issue. Its current retail dropped sharply from a healthy 1.22 to 0.99, below the safe level. This suggests recent pressure to repay short-term dips. The quick retail fall even more, from 1.13 to 0.88, showing a growing reliance on inventory and external financing to cover liabilities. In contrast, Johnson & Johnson should realize its recent retail decreased slightly from 1.16 to 1.11, staying above 1, which is still healthy. The quick retail also edged down from 0.91 to 0.86, although it is below 1. This level is acceptable because ZHANG has strong cash generation and high-quality receivables, reflecting solid balance sheet stability.
My name is YUJIE. I will introduce the part of operating efficiency analysis. Moving to operating efficiency, we see a mixed picture across inventory management, receivables collection, and asset utilization. Firstly, inventory management, both Starbucks and NIO showed improvement. Starbucks inventory turnover ratio increased from 13.12 to 14.77, indicating faster inventory movement and better supply chain management. NIO's ratio rose significantly from 7.8 to 9.58, showing better inventory control and alignment with market demand. Johnson & Johnson's ratio decreased slightly from 2.48 to 2.33, which is typical for its sector with longer product cycles. Next, days sales outstanding, which measures collection efficiency. Starbucks maintains a very low DSO, increasing only slightly from 11.97 to 12.1 days, consistent with its cash-based model. NIO showed remarkable improvement, slashing its DSO from 32.08 days to 17.59 days, indicating much faster collection of receivables. Johnson and Johnson DSO improved modestly from 61.96 to 61.06 days. A longer collection period is standard in healthcare, dealing with institutional buyers. Finally, asset utilization. Both fixed and total asset turnover ratios indicate that Starbucks' efficiency decreased as asset growth outpaced revenue. Conversely, New and Johnson improved their total asset turnover, meaning they are generating more revenue per dollar of assets, with New showing particular gains in production efficiency. Okay, next.
Now, let's examine leverage and service, which reveal the financial risk profile and dividends on debit. The debit ratio tells a clean story. Starbucks has an exceptionally high ratio through it decreased steadily from 127.13% to 123.75%. A ratio over 100% confirms a negative equal portion, meaning the company is highly leveraged. NIO experienced a significant increase in leverage with its debit ratio jumping from 74.79% to 87.45%. This marks an escalating financial risk and heavier release on borrowed funds. Johnson and Johnson also saw an increase, but from a low base from 58.96% to 60.31%, remaining within a conservative and manageable range. The interest coverage ratio, which measures the ability to pay interest from operating profits, confirms this. Starbucks ratio declined from 10.82% to 9.84%. While it remains in a reasonable safety zone. NIO, however, continued to post negative coverage ratio, meaning operating profits are insufficient to cover interest expense. The loss has narrowed, showing some improvement, but the inability to survive interest from operation remaining a critical concern. Johnson and Johnson's strong and improving coverage ratio refocused its solid financial position with ample earning to cover interest cost. Okay, I'm finished. Please, next one.
My name is XINYU. Our profitability analysis shows diverging paths amidst the challenging environment. On the relative basis, the profitability of Starbucks and Johnson & Johnson weakened in the recent period, where you showed improvement from deeply negative starting point. For Starbucks, increasing cost pressures led to decline across all key margins. Operating margin, gross margin, and net profit margin fell. New story is one of significant progress, but ongoing challenges. Its gross margin improved substantially from 5.49% to 9.88%, indicating better pricing power and cost management. However, its operating and net margin remain deeply indicative due to higher operating expenses and other costs. Johnson & Johnson maintained the exceptionally high gross margin, which even improved somewhat from the prior year. However, its operating and net margin fell, primarily due to one-time factors in the 2024, noted a deterioration in this core business. The better ratio, which reflects in operating earnings to total success, decreasing for Starbucks, worsened starting for New, but improved for Johnson and Johnson, indicating stronger operating earnings relative to asset base. Okay, I'm finished. Next one.
Okay, my name is Zhang FUXIANG. The return analysis summarizes the ultimate outcome for investors. Both since Starbucks and Johnson & Johnson expressed declines in return on assets (ROA) and return on equity (ROE). NIO's already negative returns wasn't further. For Starbucks, the decrease in ROA is attributed to lower margins, not operational efficiency. Its ROE is heavily skewed and continues downward due to the absence of positive shareholder equity. For NIO, the decline in ROA and ROE stems from continued operating loss and increased debate levels, which amplify losses on the equity side. For Johnson & Johnson, the substantial drop in ROE was driven primarily by a large decrease in net income due to non-recurring events, not a change in its underlying business model. Earnings per share (EPS) turns mirrored this. Starbucks EPS fall moderately. NIO's loss per share decreased slightly. Johnson & Johnson's EPS fall sharply due to those one-time events. Introducing the DuPont analysis help us decompose ROE. For Starbucks, its historically higher ROE was driven by a combination of high financial leverage and stable profit margins. NIO's negative ROE is a product of operating loss and increasing leverage. For Johnson & Johnson, the recent decline in ROE is primarily due to the drop in net profit margin, while its asset turnover and leverage have remained fairly stable. Okay, next one.
Overall, our comparison shows three different morning stories. Johnson & Johnson is like the poster child for financial health. Even when they had a rough patch, they kept cash handily, stay low on debt, and keep profits strong. Their issues are temporary, no building force. Starbucks pulls off a balance between risk and reliance. They are highly leveraged and have weak-looking liquidity on paper, but thanks to that powerful health, global brand, and rock-solid cash flow, they keep things in check. The real test is whether they can keep that cash flowing. NIO's playing a high-risk, high-growth game. They've made some real progress lately. Better inventory control, faster payment, and improved margin, but they are still losing money. Returns are slipping, and they lean heavily on broadening to keep growing. The future depends on turning that growth talk into actually profits, and soon. So if you are all about stability, Johnson & Johnson's your pick. If you are okay with some risk but want steady cash flow, maybe Starbucks. NIO still a bet on growth turning into financial independency. Definitely not for the fan of heart. That's all.
Okay, thank you.